Have you ever wondered what happens to the stock market when a country's currency suddenly drops in value? It might sound like a recipe for disaster, but for savvy investors, it can actually signal a massive opportunity. This is what we call the devaluation trade. Let's break down what currency devaluation is and how you can potentially use it to your advantage. So, what is currency devaluation? Simply put, it's when a country's currency loses value relative to other currencies. For example, if one US dollar used to buy 100 Japanese yen, and now it buys 120 yen, the yen has devalued against the dollar. This can happen for many reasons, like changes in interest rates, economic instability, or governing policy. The devaluation trade is the strategy of investing in assets that benefit from this currency drop. Now, how does this affect a country's stock market? It's a double-edged sword. On one hand, a weaker currency can be a huge boost for companies that export goods. Imagine a Japanese car company. When the yen is weak, their cars become cheaper for American buyers. This can lead to a surge in sales, higher profits, and a rising stock price. On the other hand, it's not all good news. Companies that rely heavily on importing raw materials or components will face higher costs. A weaker currency means they have to pay more for foreign goods, which can squeeze their profit margins and hurt their stock. Also, foreign investors might get nervous. If they hold stocks in a country with a devaluing currency, the key is to look for export-oriented economies or specific companies that will benefit from a weaker local currency. Think about countries known for their manufacturing and exports, like Japan, South Korea, or Germany. When their currencies dip, their major export companies often see their stocks climb. Emerging markets can also offer exciting opportunities. These economies are often more volatile, and their currencies can experience significant swings. A well-timed investment in an emerging market ETF, just as its currency starts to weaken, can lead to substantial gains. Specific ETFs you might look into are those that track major international stock indices, or even country-specific ones like EWJ for Japan or EWY for South Korea. However, this strategy is not without its risks. The biggest risk is timing. It's incredibly difficult to predict currency movements accurately. You might invest expecting a currency to devalue, but it could strengthen instead, leading to losses. Political and economic instability are also major concerns. The same factors causing a currency to devalue can also create a risky investment environment, potentially leading to a broad market collapse that outweighs any currency-related benefits. And don't forget about inflation. A weak currency can fuel inflation, which erodes the real value of your investment returns. To wrap it up, investing around currency devaluation can be a powerful strategy, but it requires careful research and a strong stomach for risk. Focus on strong, export-driven companies in countries with weakening currencies. Consider using ETFs to diversify, and always be aware of the economic and political risks involved. By understanding both the pros and the cons, you can make more informed decisions and potentially find some incredible investment opportunities. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit that notification bell for more investment insights. See you in the next video.